system that just ain't right. Gonna tear it down, gonna start a fight. Anarchy and numbers is my game. I'm the investor with no shame. Greed and corruption, that's the name of the game they play. It's all the same. I won't play by their rules, I won't comply. Anarchy's the way. It's time to fly. I'll burn down the walls and break the chains, shatter the illusions, expose their games. The stock market.
And here we go. Welcome. I'm Matt. This is the Anarchist Investor coming at you live every Monday through Friday at 12 Eastern, talking about contrarian investments, markets, the economy, how to protect and grow your money without getting it stolen by some dirty banksters. A reminder, help me out with the algo. A little thumbs up, a little subscribe, a little follow, a little share goes a long way towards helping the channel, but it also goes a long way towards helping other people get this information. And I think it's pretty high value. The fact that you tune in probably means that you think it's high value too. So make sure to share it with the people that you, think and know and love and appreciate, and get them that information as well. All right, I'm going to pull down the scrolling banner here. I'm going to put back up the share screen. And on the share screen, I have the 10-year yield. I'm going to have to keep talking about the treasury market. It is at the center of everything that's going on, because this is the place where literally the most manipulation is happening. It also means it's the place where the most kind of disjointedness exists within the overall economy. Again, the Wall Street economy, not necessarily on Main Street, though this does have some knock-on effects to how Main Street operates, mainly in terms of borrowing rates, okay? But so we're looking at the 10-year yield. If you notice, last few days, 10-year yield is getting slammed lower, and this is because people are buying, a lot of big money buyers are buying the underlying bond, which is the 10-year U.S. Treasury. They're buying the bond, the price is going up, which means the rate goes down, which means borrowing costs are going lower, all right? But this is something that's very important. This is not just in isolation. You have a yield curve that runs from very short-term, debt structure to long-term debt structure. So at the longest end, you have the 30-year U.S. Treasury, okay? That's being actively bought. You have the 20-year U.S. Treasury. That's being actively bought. And I told you for the last couple of weeks, I said, if you can stomach putting your money into a brokerage or something like that, I'm not your guy when it comes to stock picks and stuff like that, right? But if you could stomach it, TLT, which follows the 20-year U.S. Treasury, was probably a really good investment. And since it bottomed out in 2023, it had a little bit of a bounce. It pulled back. Now it looks like it's putting in a higher low, and now that means that you could get a pretty decent rally off of this point. There's a number of people advocating that you at least look at this, but it's coinciding with the decline in the interest rate, or the rise in the price of the 20-year U.S. Treasury. This is where it's really strange, and this is why I've entitled this, the yield curve seems like it's broken, okay? The short end of the curve is being bought, but it's not being bought as quickly as the long end of the curve is. And so this is really strange, because the yield curve's been inverted for a really freaking long time. It's been one of the worst inversions that we've ever had in U.S. history, in the entire economic history of the United States of America. This is one of the worst inversions we've ever had, if not the worst. And every single time it looks like that inversion is going to de-invert, meaning, the 2-year yield, which is higher than the 10-year yield, when it looks like it's actually going to de-invert and put the yield curve back on that normal bottom left to upper right kind of structure that we normally see in terms of the interest rates, it just gets slammed right back down, right? A couple of times now I've talked about the attempted de-inversion of the yield curve. And every single time this thing looks like it's going to get de-inverted, just wham, it just gets nailed again, okay? So why is this happening? Well, it's a couple of things, really. First of which is obviously the Federal Reserve. The Federal Reserve has mucked around in the interest rate markets, okay, is keeping the short-term rate higher, at least in the near term, and there's a lack of transparency about when that rate is actually going to head lower. And so if you're looking to buy US Treasuries, yeah, you could buy on the short end expecting that price to go up and the rate to go down, but you don't know for sure when it's going to happen, if at all, right? What you do have a reasonable expectation of is that, on a 10-year basis or a 20-year basis, the rate is going to have to go down. The reason why it's going to have to go down is because if it doesn't, most US banks are going to go bankrupt. Okay. And actually, the same can be said about the short-term rate. But again, the short-term rate is being artificially held higher. So what's the better bet? The better bet is buy a 5-year or a 10-year, because you also have more time, right? You could buy that bond and then say the Fed doesn't cut interest rates for another 6 months. Well, whatever. That bond doesn't mature for 10 years. That's, 1/20th. It's basically 5% of the total time that bond is going to exist. I mean, that's nothing. That's peanuts. We'll sit there and deal with, 6 months of, slightly negative numbers sitting on the balance sheet or on the profit and loss statement in order to finally realize those rate cuts when they come along. That's part of it. It's the Federal Reserve essentially not being transparent or not giving good forward guidance in terms of when it's actually going to cut interest rates. Now, interestingly enough, when the Fed was raising interest rates, okay, it caused turmoil at the beginning because that marked a big shift from zero interest rates to now raising interest rates to quote unquote battle inflation. Okay. But once that initial disruption was kind of baked into the numbers, then all of a sudden the subsequent interest rate hikes didn't really cause as much trouble, right? Like you see this big whipsaw right here that happened basically in 2023. This was kind of like indecision. Like, is the Fed going to cut? Is it not going to cut? Oh, it didn't cut. All right, we're going to come back, right? But now when you look back here, there's just this steady climb in the 2-year going back to 2021 when the Fed said, all right, we're going to start raising interest rates. And you see a couple of small hiccups along the way, but there was no misdirection. Like the market assumed that the Fed was going to be raising rates. And so the default was for rates to go higher. And it was just a matter of, all right, where's it going to end? Right. And that also meant like on days where the Fed raised interest rates, sometimes the stock market would sell off, sometimes it wouldn't. But overall, the market just continued to head higher once the initial kind of like upset was over in 2022. Now, that being said, the damage that began to start in 2022 will eventually come due. And I would argue it's coming due right now because a ton of economic numbers like the ISM and the manufacturing numbers, the PMIs and stuff like that are just not good. And not only are they not good, they're like historically not good, like recession, not good. Okay. So, the reactions to the interest rate decisions by the Federal Reserve is one reason why you have this dynamic. Why is it that people are putting money to work in the 10-year and the 20-year US Treasury, but not as much in the 2-year? And why is it that every single time this yield curve looks like it's going to de-invert, it just gets slammed right back to being inverted again? The other reason is economic uncertainty. Now, typically, the economic uncertainty in the United States means that the short end of the curve, the rates are going to get cut, right? But right now, there's no faith in the Federal Reserve that they're going to cut when they need to. I'll use air quotes again, when they need to, okay? You got to remember, this is coming from someone who does not believe that the Federal Reserve should be mucking around in the interest rate environment at all. In fact, they shouldn't exist, okay? Because they do nothing but intentionally cause these huge outsized just kind of discrepancies in where the economy and the markets move and where they should be moving and what prices should look like, right? They cause these disturbances and they cause bubbles, they pop bubbles, right? Like, and it's intentional, right? It's manufactured, controlled chaos so that the people that are in the know can make tons of money, and the people that aren't in the know, they just kind of go along for the ride, and they get stolen from, and little pieces get picked off of their nest egg here and there and here and there, And then at the end of the day, your investment advisor's like, oh, congratulations, you averaged 5% returns over your entire, investment career. Congratulations, you have this amount of money. And never are they like, but off of your back, all these other people made that much money, if not more, and you didn't get to keep any of it, right? So anyway, the economic uncertainty that's associated here with the current economy is also impacting things here, where in the short term, there's like a liquidity concern. There's a huge liquidity concern in the short term. And so if you were to buy short-term bonds here and they were to not go anywhere, right? But then the market, shit the bed or something, you might end up having a liquidity issue. Now, the Federal Reserve, the U.S. Treasury is also issuing absolutely tons of short-term debt, okay, which is the third piece. And so they're issuing tons of short-term debt because they also expect in short order, the Federal Reserve will return to a low interest rate kind of environment, in which case the Fed can then, the U.S. Treasury can roll those short-term notes and bonds into longer-term, lower interest notes and bonds. So they're issuing tons of this stuff, which means as people buy the 10-year and 20-year, even if they buy the same amount of the 2-year, there's much more supply coming into the system at the short end of the curve, because the U.S. Treasury is just, they are in full-on borrow and spend mode, like they've never been in their entire lives, like we've never seen our entire lives, like the country has never seen our entire lives. This ain't even close to World War II, right? This is like in a whole other universe of borrowing and spending. So you have supply that is also inundating the short end of the curve. So even if you have the same amount of demand across the entire yield curve, you're not seeing the yields drop as quickly on the short end because there's just so much more of this stuff. And so as those bonds get purchased, the price doesn't really go up. The U.S. Treasury just keeps dumping them onto the market and dumping them. And so the price goes up on the 10-year and the 20-year, which means the rate goes down, which does provide a little bit of rate relief in terms of, say, like mortgages and whatnot, okay? What it's not helping, and this is the irony, what it's not helping is banks, because banks borrow at the short end of the curve. And so any kind of rate relief that's happening at the short end of the curve is needed. It's much needed because the banks and the inverted yield curve have basically been undermining the profitability of those banks, and not just the profitability today, the profitability over the next 10 or 20 years, because they've had to borrow at such high interest rates. Well, they're not getting any relief out of the decrease in the interest rates on the long end of the curve, if in fact it's actually making things worse. So the more the U.S. Treasury dumps bonds onto the short end of the curve, the worse it gets for commercial banks and the big retail banks out there, because now they're not getting the rate relief in the short term where they're borrowing from the Fed window or just borrowing from each other. And at the same time, they're getting less interest income coming from longer term lending, like mortgages and commercial development loans and things like that, right? So this is doing, like, the yield curve was bad, and I didn't think it could get worse. Like, I thought we were going to just eventually de-invert, bang, we'll have to take our medicine, the recession is going to happen. Every single day that passes, this thing does damage and more damage and more damage. The foundation of the building, it's like erosion, right? Like if you have a house at the beach or whatever, and for some reason or another, the high tide now all of a sudden reaches your house, okay? It doesn't like knock down your house immediately. It takes time, right? But the longer that tide remains high, it undercuts the foundation more and more and more and more. Eventually, the house falls over. Well, that's what we got right now. The longer this happens, the longer this situation exists, the worse it gets. And on top of that, we have economic numbers that are showing that the Federal Reserve probably, and this always happens, the Federal Reserve is always late. They're always late because as much as they want to say that they're not a political organization, they always look for political cover. They're always looking for a political excuse to cut or raise interest rates. So they're always late. By the time they get the political cover, it's too late. Okay, same thing's playing out right now. They're going to be late. They're already late. Okay, and so you're seeing the undermining of the U.S. economy right now. Meanwhile, in the stock market, you're not really seeing it because, again, the euphoria and the risk taking, a lot of it is being fueled by people thinking that they don't have any other option. Okay, see stonks going up like GameStop and whatnot. See people placing way too much of their portfolio in things like Bitcoin and crypto and whatnot. You're seeing this time and time again because people are desperate. They're trying to make up the stagger, and the economy continues to get worse and worse and worse all along. Meanwhile, all those people that are taking those risks should be getting super conservative, and they're just not. They're letting it all hang out, thinking that they're going to get, wealthy because of it. And truthfully, we have a really bad downturn before we get this next wave of inflation, because the money that is held within these institutions and these large investment firms, it's not being held to be deployed like tomorrow. It's being held for a while because they know what's coming. And so they're going to have to see who survives. And then if you survive, you'll have this cash hoard to be then able to go out. And I mean, we're going to see a wave of consolidation in terms of market share like you've never seen before. I mean, it's all been government aided up until now in terms of like the banking industry and real estate industry and whatnot. You're going to see other areas. I mean, like retail, small mom and pops are going to go out of business like crazy. And who's going to survive? It's going to be idiocracy. You can have Costco, Walmart, and a couple other names. Maybe Target survives, right? And it's just they're going to be one of the only games left standing because one of the only games in town left standing because they'll have the cash hoard to be able to fall back on when this actually hits the fan. But in the meantime, there's just this ridiculousness happening in the fixed income markets. And we have yet to actually see reality hit the rest of the casino, but it's coming. And unfortunately, there's going to be a short period of time where when the Federal Reserve finally does go, okay, we have enough political cover to cut, people are like, oh, there's going to be a big sigh of relief, and then some stuff will rally, and then everyone will be like, oh, we're, no landing, we're moving out forward, it's going to be fantastic, we're back into growth mode. And then a couple of months later, it's going to be like, woof, that's when the rug pull is going to happen. I wish I had a better prediction, but I mean, that's basically what's happening, and buyer beware, right? Like where you're buying things, there's a reason why the 10-year and the 20-year are a better bet right now than the short-term end of the U.S. Treasury market. While I'm on fixed income, we'll go around the rest of the market. We'll keep with fixed income. We'll look at high yield bonds, and then we will move on to the rest of the broader market. High yield bonds today are slightly down. So, flat to slightly down. Again, hovering right below this line of resistance. And the question becomes whether or not we're actually going to see a breakout here, which I would argue would probably be a false breakout, or if it rolls over. Something I've also been watching here in conjunction with this. So this is one indicator we look at, and it's usually a forward-looking indicator in terms of if risk is being taken in the market. I'm going to pull over. I don't often look at this, but like here are like the different sectors of the marketplace that I watch. This is the regional bank index. Okay. And like I said, there's going to be consolidation like you've never seen before. We've already seen consolidation in financial markets in the financial sector. Okay. With JP Morgan and Bank of America and Goldman Sachs and Wells Fargo just gobbling up market share left and right. Right. And they're all globally systemic investment banks or and so they can't be allowed to fail. Well, the regional banks apparently can be allowed to fail. And this right here, this huge drop off in the regional banking sector, this was the, Silicon Valley Bank. This was the First Republic bankruptcy. This was Signature Bank, right? And then the Fed stepped in on the back end and added all kinds of liquidity on the back end. So the whole time they were telling you, oh yeah, we're keeping rates high and we're tightening financial conditions. Bullshit. They were trying to support the regional banks so that they didn't completely fall apart. Well, guess what? You can only kick the can down the road. You can't fix these problems. You can't fix them overnight. It's been roughly a little over a year since this initial fall off happened. This looks like a giant bear flag, meaning the drop, you get a small kind of consolidation, maybe even upward movement before the next leg down. Okay. This next leg down is going to be more bankruptcies. It's going to be more illiquidity. And in fact, it's going to get way worse than it was before. Instead of 2 or 3 banks, you'll be talking about dozens, because every single one of them is underwater on their commercial lending portfolio. They're all underwater on their mortgage. Well, their mortgage lending portfolio, they might not be underwater, but the problem is that they're not generating enough profit from that mortgage portfolio to make up for the losses and the paper losses in the other areas if there does end up being some kind of cash or liquidity crunch. And that's actually what we're headed toward. We're headed towards a shortage of dollars. And it's not because there's a shortage of dollars in system. There's a shortage of dollars circulating in the system. That's a very big thing to understand. Just because lots of money gets printed doesn't mean it goes everywhere instantaneously. There are little traps and black holes and tide pools that end up sucking up that money. And in the current environment, we have some big mega corporations that are these giant black holes that have sucked up tons of cash, and they're just holding on to it. And so for all of the money printing that happened, the inflation that happened, you ain't seen nothing yet. But you're not going to see that inflation until the all clear is called. And for the all clear to be called, we actually have to have a really disruptive event that happens, meaning the recession that we're probably already in right now. Well, what's going to happen to regional banks? They won't be bailed out. They won't. There's not enough money in the FDIC. The federal government's already spending way more money than they can afford to spend. They have been for 100 years. But there's no lifeboats for the broader regional bank index. And some of the worst banks, there was just a recent report that was put out in terms of how bad the commercial lending portfolio as well as the capital structures of these banks are. And 2 or 3 of the top 10 are all the biggest regional banks in the United States, like Bank Ozark and SoFi and that kind of thing. These banks are not going to make it. And so if you're looking at this sector, this regional banking sector, yeah, there was a little bit of a bounce that came off of the really bad, spat of bankruptcies that we had. That was the first wave. Well, the second wave's coming because nothing has gotten better. If anything, it's gotten worse, right? And like I said, yield curve isn't helping. It's making things worse every single day. So continue to watch banks because watch out. If you have money in a regional bank, I would be we have money in PNC. They're considered a super regional. I believe they fall under the GSIB designation. And so, but we also have money in a couple of other banks. And then we also have a ton of money that we just hold on to ourselves because we don't really trust banks. You got to watch out. If you have your money with a small little savings and loan or a regional bank, it's entirely possible that your money could get frozen. The FDIC won't have enough money to make you whole if you have a large amount of money there. So keep your head on a swivel when it comes to that. All right. That's what I'm looking at in terms of the sectors, just as an example of kind of how this interest rate environment is playing out. Really quickly, let's look at stocks. After Boo Boo Kitty or whatever the heck his name is, unveiled his huge position in GameStop. Well, look, first time he comes out of exile, huge ramp, falls off. Okay. This next time he unveils his position, which, by the way, is a huge mistake. Okay. He's caught between a rock and a hard place. He had to reveal his position to try and get all of the apes to pile in. The problem is all of the apes are running out of money. And so they don't have enough money to drive this thing higher the way he needs it to be driven higher. And on top of that, because he advertised his position, or supposedly, I don't know if there's necessarily a full clarification as to whether or not that actually is his position. But because he advertised his position, now all of the hedge funds know who they're betting against, and they're able to essentially take the other end of the trade and pile up against him because they're going to take the opposite end of the trade. His bet is that all of the individuals, all of the apes, all of the Wall Street bets people are going to go after GameStop and drive the price up. And look at the results. It's not happening. 1 pop, 2 pop. He'll be lucky to get another one. All of his options expire in 17 days. So we'll see what happens in 17 days, but I fully expect this thing to just fall back apart and this guy to essentially burn and donate like $200 million to Wall Street. So we'll see what happens. And it'll be along with not just his money. It'll also be along with a lot of other average people's money, like in the Wolf of Wall Street, when he's sitting there selling penny stocks to plumbers and mailmen and, factory workers, right? Those are the people who are going to end up losing their money, along with a bunch of Gen Zers and millennials that really, if they just put their money away in something safe and secure, have the benefit of 20 or 30 years, but they want to get rich right now and stick it to the man, apparently. Well, we'll see how well that goes. So, yeah, we got that playing out. NVIDIA, let's look at NVIDIA really quickly. I normally don't spend this much time on stocks, but figured since we're talking about the market and yield curves, we might as well talk about the casino a little bit today. So NVIDIA, again, we get these gaps up. If I zoom out here, these are gaps up to all-time highs. If you notice, the relative strength is lower on these all-time highs. If that continues the way it is, this will ultimately be the final hurrah, so to speak, for NVIDIA, and then you'll start to see some huge liquidations, because this is a crowded theater. Like this individual stock, the sector specifically, or the sector in general, but NVIDIA specifically within the semiconductor sector, this is a crowded trade. So many people are long this trade. The shorts have gotten destroyed every single time they thought that there was a top happening. The shorts got destroyed. So the short interest is not there right now. And so there's not going to be a lot of buying support when someone yells fire in this theater. It's going to be a rush to the exits, and it's going to get ugly. Okay. There is a huge discrepancy right now in terms of the relative strength between the last time NVIDIA hit an all-time high and this run right here. If this holds up the way it's holding up right now and stays the way it is, I doubt you see higher highs in NVIDIA, at least in terms of relative strength. And that means that you're pretty close to the end here. And like I said, that end is going to be something to behold, ladies and gentlemen. I would not short this right here. It could always pop again because of just how illiquid this is. Like I said, the shorts aren't shorting because they've gotten killed too many times, which means you get a gap and then you get another gap, and there's just no one on the other end of the trade. And so it's just nothing but people buying more shares from other people that have shares. And because there's such a restriction in the supply of shares available, the people that are selling the shares are like, all right, I'll sell you the shares, but you got to give me a huge premium, right? So you get a gap up. And then, I'll sell you the shares, but you got to give me a huge premium. Get another gap up, all right? This thing can continue gapping, all right? But on lower and lower relative strength, because it's not that there's like an excess of demand. There's just a lack of people actually selling, which causes this huge imbalance in terms of the price that eventually causes a crack down, essentially a deflation of this asset bubble. And like I said, it is a crowded theater. And if someone yells fire, watch out. All right. The broader casino is down today. Again, there's been bad economic numbers. And if there's no faith that the Federal Reserve has the desire to cut rates anytime soon, then bad economic numbers, bad news actually equals bad news. Okay. It's not until the broader marketplace and the broader casino gets the sense that the Federal Reserve is looking for bad numbers to cut rates. Okay. Once that gets flashed, and it could be flashed at this next Federal Reserve meeting, once that gets thrown out there, then it becomes bad news is good news. Okay. And that's when you get this dead cat bounce that's coming up here sometime in the near future. But yeah, S&P's down, NASDAQ's down, pretty much everything's down. This could also be a ton of profit taking that's being rolled into the U.S. Treasury market in order to lock in some of those rates while they're still above 4%. So that dynamic happens quite often here. A lot of risk off, so to speak, happening if you foresee U.S. Treasuries as being low risk. What else? Volatility's up again. The dollar isn't really falling today. It's just kind of holding time here. So we'll see what happens. I mean, yesterday it definitely seemed like the story was, rate cut. Today it definitely seems like the story is we need a rate cut, but we're not going to get it, if that makes sense, or there's no faith we're going to get it. So we'll see how that plays out. I wrote an article earlier today on the Substack. If you're not subscribed yet, subscribe, anarchistinvestor.substack.com. I wrote about oil, Friday, gasoline prices were in contango. If you don't understand what contango means, it's not good, not when it comes to energy prices, and you should be subscribed to the Substack if you're not. As an added Benny here, as an enticement, I gotta make myself bigger on the screen here because it just doesn't have the gravitas. This is 5 ounces of silver. Okay, at today's prices, this is north of $145. Okay, I'm going to be giving away 3 of these to subscribers, regardless of whether or not you're a free or a paid subscriber. And then I'm going to be giving away 2 to just the paid subscribers, which means if you're a paid subscriber, you get a shot at all 5. If you're a free subscriber, you just get a shot at the first 3. Okay. But that being said, you got to be a subscriber in order to be in on the drawing. It happens July 1st live on this program. So make sure to either click the link or just in your browser, go to anarchistinvestor.substack.com and put your email in, and you get a chance at some free silver. I mean, where are you going to find a better deal, especially in this environment where people are buying stonks and mortgaging their house to buy Bitcoin because they're running out of money? I'm giving away free silver and it doesn't even cost you anything. If you are a paid subscriber, it does cost money, but I think you get a huge amount of value out of it. So, but that's just my opinion. So with that, I wrote an article earlier today about the energy market. If you notice, continues to be weak. This is despite OPEC Plus keeping in place supply constraints. If you understand general demand, supply demand, you understand that when supply is constricted, prices should go up if demand stays the same. But if demand is going down, and that's why OPEC is constricting supply, then that's why the price is falling. Okay? There's just no demand. And it is June, people. Okay? People start hitting the road in July, right? Like summer driving season in the United States specifically starts July, August. That's vacation time. All right? It's June. This shouldn't be happening, right? Let me go out and let me see if I can't pull up some examples of what June looked like in the past here. So let's see. This is June of 23 is right here. Like the bottom. Okay. And throughout June, July, August, you see this huge ramp up in oil. We're looking at the West Texas Intermediate contract. Okay. Let's go back to June of 22. June of 22, we actually saw a top out in oil prices. Okay. But if you notice, leading up into it, you saw the high in oil prices, which, by the way, in the article, spoiler alert, I talk about whether or not this actually broke the back of the consumer. Okay. This rip in oil up to 130, give or take, and then the subsequent rise back up to 120 a few months later, this potentially broke the back of not just the consumer, but also the industrial base of the world economy, okay, the global economy. But if you look in June of 22, we actually topped out, but you still got this big rise in anticipation of that, okay? And if you remember in June of 22, that's also about the time when, rate cuts really started to be the thing that people were worried about and became fully aware that it wasn't just going to be a couple of rate cuts. We were headed to much, much higher interest rates. And so that was the beginning there. But you still saw a run up in anticipation of it. Okay. Right now, we've seen a run up starting in January up until April. Okay. But that fell off even earlier than it has in the past in terms of this. Now let's go back to, say, like 21. Let's look at June of 21 here. If I can make this work. All right. June of 21. All right. We ramp up in anticipation. It fell off and then it ramped again. All right. Leading into fall. Now, you had the dynamic also here of Russia, Ukraine. You had the dynamic of Europe having problems importing energy and natural gas and all this other stuff that was going along with this. But if you notice, the trend is higher. Okay. Let's go back to June of 2020. Now, this might be a little bit of an outlier, but let's see. June of 2020, coming out of the dregs of the COVID pandemic, okay, and the lockdowns, notice oil rebounds, it moves sideways and then moves higher. But you still continued to see some rally here into June and July, even despite the fact that the entire economy was shut down in the United States and a number of other countries. You saw that. Okay. Now let's go back to what was considered, quote unquote, a healthy time period in markets. Okay. And I use healthy in quotes because I've covered many times how, uh, the 2018-2019 dynamic was anything but. We should have had a recession back then. In fact, look at this. In October of 18, after you get the run up in gas prices through, let's see, June, you get a run up, then you get a secondary run up later on. That also has to do with heating oil and stuff for the winter. And all of a sudden, see this big crash right here? That coincided with the time period when, and this is 2018, sorry. This coincided with the time period where all of a sudden the Fed was like, oh shit, what did we do? We have to reverse everything. Okay. This is what you got. Well, that cascading effect we could be in the beginnings of that right now. Okay. We've already seen a lower high and then a secondary lower high on oil. This could end up being the beginning of that cascade downward in oil prices because of the recession and because of the fact that there's just not demand. The Saudis and OPEC could restrict supply as much as they want, but if there's no demand, then companies aren't going to, a lot of companies are just going to sit on the oil and they're going to store it because it's not worthwhile to sell it. Because in a lot of cases, it might be actually selling at a loss, depending on what the price ends up looking like. So we'll see what happens here, but this looks like if it continues, this is the beginning of what could be a really, really bad sign. And in fact, I would say that because Gasoline Friday was in contango and the oil supply curve, the futures curve right now looks like it's headed towards contango as well. It's not a good sign, folks. Not a good sign whatsoever. All right, what else we got working in the casino and the commodities markets? Dude, lumber, man. Look at this. This is like, in Mortal Kombat terms, this is like a fatality. We got a bump up in lumber prices, and it was just like, okay, maybe we're headed higher. Nope, right? Like, what's funny is this is almost kind of like the dynamic that's playing out in the yield curve. It's like a little bit of optimism and just bang, like slam it right back down. This ain't healthy. Like, that's not a healthy economy. This is lumber just getting absolutely destroyed, literally taken to the woodshed. Okay. Gold and silver are weak again today. Again, there's some like flight to safety type stuff happening today. There's some profit taking stuff. There's buying of U.S. treasuries. It's entirely possible that people are in the paper markets, at least, taking their profits on gold and silver and buying U.S. treasuries or just holding cash and locking it in. Okay. That doesn't mean that the gold and silver trade is over. Not by any stretch of the imagination. All right. We are toying with some important levels here. So we have to see whether or not these get held. Silver violated $30, but again, silver is a lot more volatile than gold is on a pricing standpoint. So we'll see what $30 in silver. I'm actually looking at like this line right here is about $29. I would think $29. And in fact, I'm going to put a horizontal line here just to show you and see what happens around $29. I would say it's like $29 and like 2 cents, give or take. I'm going to put a horizontal line there. Let's see what happens at $29. I bet you see some buyers coming in at $29 an ounce on silver. But again, this could just be a lot of profit taking and locking in those profits. It does not mean that the trade is over. It just means this thing is taking what I would say is a well-needed deep breath. Okay. And again, we got a couple of months yet where I think the end of July, we'll get some really good resolution as far as the direction of not just the economy and the stock market, the economy and the stock market, aka casino, as well as commodity prices towards the end of July, because I think we'll have more clarity on how the Fed is going to manipulate the markets moving forward here. And again, just to pat myself on the back, look at this bounce in the gold to silver ratio right off of this line. And look at this hard ass bounce in the gold to silver ratio. This has shown that gold in the near term has been outperforming silver. And that's just, it is what it is. Nothing goes straight up. Nothing goes straight down. Does this mean now that gold's going to outperform over a longer period of time? No, I don't think so, because 78 is still an over, like a overvaluation in terms of the gold to silver ratio. So I would think that this thing does stay a little bit higher, but eventually you will see the gold to silver ratio come back down and re-challenge this 72, 73 level. So don't bail on silver just yet. In fact, most of you should just be buying gold and silver to hold on to it, not to trade back and forth. Okay. But don't lose faith. It's not like silver's falling apart here. It's not like gold's falling apart. This is a natural progression that's happening. And the markets are being logical here, as opposed to, I mean, you could make the argument that the markets are being logical in terms of the yield curve and US Treasury rates, but I mean, that logic is based off of a huge amount of manipulation. Aluminum, a little bit of an update. Again, this is a tariff story that continues to play out. And that's really, I mean, palladium continues to be weak here. Again, another symbol that this is not great for, the commodity space. There's some things that are holding up, but really, by and large, this is not an inflationary story. DBC, the ETF that I look at to look at commodities prices, continues to be weak again. Okay. This is not an inflationary story. If anything, we're on the verge of deflation. We're on the verge of prices getting cheap, but they're not getting cheap for the good reasons. They're getting cheap because just no one's buying shit and because they don't have any money. Okay. It also means that there's going to be a liquidity crisis when it comes to the financial sector. All right. Let's finish up with crypto here. Bitcoin's having a good day. It is outpacing Ethereum still. This looks like a breakout is starting to form here on Bitcoin. I think Ethereum is going to follow it, and Ethereum eventually will outperform Bitcoin in terms of the overall percentage gain. But today, Bitcoin is the leader. It's been the leader for the last couple of days, and that's after Ethereum was a leader for a handful of days because of the ETF news. Remember that news still isn't solidified. It was just a rumor. I think you'll probably see another pop in Ethereum headed into the actual announcement of the ETF being approved. Okay. So don't bail on Ethereum yet either. Just because we have a couple of days of Bitcoin outperformance doesn't mean that Ethereum's in the doghouse. It's just taking a break. There's some people realizing some profits. And then, like I said, you'll see another pop in Ethereum probably headed into what will then be the news. And then what I would say is if you are trading this, say you have a core position, but then you have a piece that you're using as kind of like a trade, I mean, that might be a good take profit time, right? The buy the rumor, sell the news kind of situation. So keep watching Ethereum, keep watching Bitcoin. The overall crypto marketplace is not up as much as Bitcoin, but it's only lagging slightly, maybe by about 0.4%. And that's because Ethereum isn't keeping up with Bitcoin today. There's a number of other cryptos that are up today. In fact, most of the crypto complex is up today with a few exceptions. Bitcoin Cash is up pretty decent today, mirroring Bitcoin's gain. Actually, if I'm putting my money on it and I'm a crypto maxi, I don't think that there's a bubble that's about to pop anytime soon. I would actually be more over leveraged towards Bitcoin Cash. I have some Bitcoin Cash. I have more Bitcoin just because that's the position that I built. But I'm really thinking about stopping or dramatically reducing the amount of Bitcoin I buy every single month and just transferring that to value averaging into Bitcoin Cash. Because I think Bitcoin Cash has a move in it coming, like a serious move coming here in the near future. And I would say that Bitcoin Cash looks poised to pop higher, especially if Bitcoin leads. You could see much more upside out of Bitcoin Cash. And so as far as Bitcoin's, I wouldn't necessarily call it safer. I would say that it's more likely that Bitcoin rises than the other two. But I would say that the other two have a much higher, this is the way risk management works. The other two have a much higher ceiling in terms of what kind of percentage return you're going to get. You could see a huge move here out of either or both Ethereum and Bitcoin Cash headed into the next couple of months. So keep an eye on that. All right. What else we got working? Like I said, most of the crypto market space is up 2%, 2.5%, give or take. So some things are a little bit better off than others. Solana, Avalanche, some of these names will pop later after Bitcoin and after Ethereum and after Bitcoin Cash. In fact, they'll probably pop with Bitcoin Cash. So you'll probably see a pop in Solana. You'll probably see a pop in Avalanche that happens with Bitcoin Cash. So you could always make that trade. But again, I don't advocate for trading. So yes, just something to watch there in the intermediate term. I have transferred some more Hive back dollars into Hive into the underlying crypto. So I took the stable coin out of the savings account that I'm making 20% on, y'all. I took some of the money out of the savings account, converted those dollars into the underlying crypto. I think anything under 30 cents on Hive is a steal in terms of the price of that crypto. I can't stress to you enough how robust I think that crypto, that blockchain is going to be here into, not just like the next couple of months, but years down the line. Okay. In 10 years, I'm thinking Hive won't only just be around, it will be a force within the blockchain and crypto world. So anything under 30 cents, I'm a buyer. And so I haven't put like a ton of additional cash into the pot, but you also have to remember on the Hive blockchain, I'm rewarded for posting, creating content and stuff. So I'm still generating more crypto every single day and being rewarded for placing that content on there. In fact, right now I'm streaming on Vim TV, VIMM.TV. Unfortunately, I think Vim is being taken down here in the near term just because of the dynamics that are happening. There's some apps that are rising up and some that are falling, but it's an example of I'm posting content and I'm getting rewarded for it for the upvotes. So I get to then repurpose that crypto, whether I hold on to the base layer crypto or whether or not I put it into the stable coin and then sock it away into the savings account and make 20%. Anything under 30 cents, I'm a buyer here in the crypto because I'm a huge believer. I think you could see a ramp up in Hive along with all of the other altcoins when they follow in Bitcoin's coattails, so to speak. So privacy coins are up a little bit. Some of the other micro caps, some are up, some are down. Not really going to pay too much attention to those. Binance coin, man, look at this. There must just be a ton of activity on the Binance exchange because the Binance coin itself, are we at all-time high? We're like close to all-time highs in the Binance coin too. So, typically I don't pay too much attention to the exchange-based cryptos, but you also have to remember that these exchange-based cryptos, in many cases, are looked at as a kind of like a bridge to go in between some of the major cryptos that are out there, even some of the minor cryptos that are traded on these exchanges. It also looks like Binance has some of like the SEC and the like criminal investigation stuff behind it, which could also be causing a pop in the Binance coin as well. So you can continue to watch that. If you do dabble in these like exchange-based cryptos, you're not going to go wrong by holding. Binance is pretty much the big kahuna right now. But there's also CRO, and then the one I follow that's more of a smaller one is KuCoin, which is KCS in terms of the crypto 3-letter ticker there. So yeah, that exchange seems to be strong because it has a lot of that bad news behind it and already baked in. So yeah, down day, though it's kind of been back and forth. I mean, but it's a down day in the casino. So that's just what we're working with today. That's all I really got for today. A reminder, help me out with the algo. If you've made it this far, I appreciate your time and energy, and any help that you can give towards the channel would be a huge benefit, not just to me, but to the channel and to the people that would get this information as a result of it. Oh, later on today, I almost forgot. Later on today at 6 p.m., I'm going to be posting the interview with Lobo Tigre. So Lobo Tigre's interview that I did this past week that I recorded, we talk about a ton of commodities, some high-level talk about the economy, the global economy, but really we dig into gold, silver, uranium, copper. It is a wide-ranging interview that is focused a lot on commodities, the commodity space, and so do not miss that. Make sure you're subscribed if you're on any of the video platforms that this streams or gets posted to, as well as any of the podcatching platforms. Make sure to subscribe so you get the notification on that. Or if you follow me on X, it will be live premiered on X as well at the same time. So definitely catch that later today at 6 p.m. And that's all I got. It is a wonderful Tuesday. It's beautiful outside. I have to go water the strawberries and the rose bushes. So that's what I got working this afternoon. Hopefully you all have an absolutely fantastic afternoon. Again, I appreciate every single one of you, your time, your energy. And with that, have a fantastic afternoon. Peace.
Stuck in a system that just ain't right. Gonna tear it down, gonna start a fight.